right. Hello, everyone. Welcome to Cama Plan Self-Directed IRAs and 401ks. Our 101, we like to do these weekly from the Cama Plan office. We do them live. And we do also have in-person events for these 101s as well. I want to welcome everybody in. We're going to get started in just a second. Just want to make sure everything's up and running. Perfect. Let's get into it. Before we get started, it's just a brief disclosure statement I need to go through. It's just letting you know that I and anyone at Cama Plan, we're not attorneys, CPAs, or financial advisors. Everything is in this presentation is strictly for educational purposes and not to be taken as advice. If you need advice in any one of those fields, we highly recommend you consult with your team of professionals to make sure that you're following their recommendations. We're happy to be a part of that dialogue at any point in time to make sure everything is quick and seamless for you at Cama Plan through your transactions. We're a neutral third-party administrator of IRAs. We will help you open your account, fund that account, and facilitate the transaction into that investment. But again, we are not CPAs, attorneys, or financial advisors. Some things we'll go over today are the basics of self-direction. What is a self-directed IRA? Different types of accounts that can be self-directed, what that means, what types of investments you can't make, some investments you can't make, or some investments you can make, some investments you can't make, how the process looks, and some brief tax considerations for you to bring to your tax professional to discuss as well. So let's get right into it. Understanding self-directed IRAs and 401ks. What is a self-directed IRA? So self-directed is just an adjective. What that means is basically you're investing your funds into alternative investments. You're telling the custodian exactly what you want to do and submitting the paperwork for that to direct that account into said investment. Again, self-directed is just an adjective. The accounts you actually are opening up are traditional IRAs, Roth IRAs, simple IRAs, SEP IRAs, 401ks, things like that. All the same rules apply, contributions and distributions. It's just the investments that switch up. You might go to Schwab or Fidelity or Vanguard, and they may say you have a self-directed IRA, but what they mean with that is you can direct your IRA into anything off of this list. With a truly self-directed IRA, like the ones at Cama Plan, there is no list. You find the investment that is right for you, and we help facilitate the transaction into that investment. This is a quote from one of our clients, a longtime client actually. Investing in what you know, understand, and can control versus using hope as your strategy. A lot of people think that you have to have your funds tied up in the casino of Wall Street, but that's not the case. You can actually take control of your investment and invest into these alternative assets that we're going to go over in just a moment, and not just hope that a certain stock or fund is going to do well for you. You can actually use your knowledge to your advantage with these alternative investments that you're doing with your personal funds and capitalize on the tax sheltered nature of the IRAs. So what types of accounts can be self-directed? In that first slide, we mentioned that self-directed is just an adjective. These are the actual accounts that you can self-direct and open and are offered at a Cama Plan. So you have two separate buckets. You have your tax-deferred bucket on the one hand, and then you have your tax-free bucket on the other hand. So what that means is for tax-deferred accounts, you don't pay any contributions or you don't pay any taxes on the amount that you contribute in the account on the front end. However, years down the line at an eligible age, when you want to take those funds out of the account, all contributions and earnings up to that point that you take out of the account are taxed based off your current tax bracket at that time. On the other hand, you have the tax-free bucket where it's the flip side. So rather than paying taxes on the back end, you're paying taxes on the front end on the amount that you contribute. Then years down the line, whatever that grows to, contributions and earnings when you take it out of the account at an eligible age, that amount is tax-free. So the way we like to phrase it is, would you rather pay taxes on the seed or the harvest? With the tax-free or Roth IRAs, you're paying on the seed, whereas in the tax-deferred account, you're paying on that harvest or that larger amount. In the tax-deferred bucket, you have your traditional IRA. You have something called a spousal IRA, which is kind of misleading. Spousal is just another adjective, like self-directed. A spousal IRA can be pretty much any one of these accounts. It just means if you have a working spouse and a non-working spouse, the working spouse can contribute on behalf of the non-working spouse for their IRA. That can be traditional or Roth or a lot of these. Again, on the tax deferred accounts, you have the employer linked plans, the IRAs like the SEP IRA or Simple IRA. SEP stands for Simplified Employee Pension Plan, and Simple stands for Savings Incentives Match Plan for employers. These are individual accounts, but they're all are linked to employers and have different contribution limits. Then you have your defined benefit plan and your defined contribution plans, your 401k esque accounts in your tax deferred side. And then on the other side, you have in your tax free bucket, you have your Roth IRA. And then you have your health savings account, which is the only account of its type where the contributions are tax deferred, and the distributions can be tax free if for a qualified medical expense. It's the only account of its type that has that nature of uh, tax advantages, excuse me. Then you have your educational savings account, ESA, also known as a Coverdell for higher education. Then you have your Roth portions of those 401ks we mentioned on the left-hand side. All of these accounts can be self-directed. You can make the same investments out of each of these accounts. It doesn't really matter. Here's a comparison between 401ks and IRAs. The main difference here is 401ks tend to have higher contribution limits. You can also only take loans from 401ks. It's either 50% of the account balance or $50,000, whichever of those two amounts ends up being less. And lastly, UDFI rules, uh, upon certain exceptions, do not apply to 401ks where they do apply to IRAs. UDFI stands for unrelated debt finance income. That's a tax that we're going to talk about towards the end of the presentation. So put that in your pocket and we'll address it a little bit later. Next up, we have a nice visual, kind of hit home the tax advantages of investing into these assets through your retirement funds like your IRAs and 401ks. This is $100,000 earned through 4 different avenues of investment, and out of that $100,000, what do you get to keep? So with your W-2 salaries, or your 1099 salaries, you're paying federal, state, local taxes. You're paying Social Security, Medicare. Your employer is also paying those taxes. In this scenario, at about a 40% tax bracket, you're paying $40,000 to Uncle Sam to help him keep the lights on, where you're only walking away with about $60,000. Again, this will vary depending, obviously, on your location. But in this scenario, it's about $40,000 to pay taxes, whether you're only walking away with $60,000. Right below it, you see your passive income, which is taxed a little bit less because you're not paying that Social Security, Medicare, or employer taxes. You get your rent, royalties, interest, dividend payments. If you earn $100,000 through that avenue, you're paying about, in the same bracket, about $25,000 in taxes, where you're walking away with $75,000. Then at the bottom, you have both a tax deferred account and tax free account. That $100,000 you earn is $100,000 you keep. However, there is an asterisk next to the tax deferred account. Why? Because like we said in a little bit earlier, when you take that $100,000 out of the account at whatever time, you're going to be taxed at distribution, which is you're going to pay a little bit less depending on your tax bracket. Whereas a tax free account, that $100,000 you take out is $100,000 cash in your pocket. This is another visual, a good visual to compare the different types of accounts. You have blue in your taxable income, you have light green in your tax deferred income, and then you have your dark green in tax free income. This is over 40 years at a 10% rate of return in a 30% tax bracket. If you invested $50,000 in each of these vehicles, 40 years later, in your taxable income, you're only walking away with $700,000 because you're paying taxes all along and the compound interest isn't as much. Whereas it's important to note, again, in the tax deferred and tax free account, you earn in both accounts, you earn $2.2 million. However, when you take it out of that tax deferred account, you're going to pay taxes on it. And in this bracket, you're paying about $700,000 of taxes and walking away with $1.5 million. Whereas in the Roth IRA, when you take that amount out of the account, you take it all out, or you take it without taxes. So $2.2 million. It's one of my favorite graphics to show people. It really hits home the point. Now, what everybody wants to know is what type of investments can I make out of a self-directed IRA? So these are some, but not the only options. What our clients invest into every day are among real estate, private lending, private placements, precious metals, and then there's that other down there. I've seen people invest into a lot of different things. I've seen people invest into livestock. I've seen people invest into fruit trees and sell the fruit. I've seen people buy bees and sell honey. So it really depends on your imagination and your ability to stay within the guidelines provided by the IRS. And then we'll go over that a little bit later as well. We're going to touch on each of these asset classes before we get to that, though. So first off, real estate. A lot of people like to invest in real estate. Some people will say real estate is. Some people will consider real estate as lending money on real estate, which you can do. In this scenario, we're talking about actually purchasing property within the IRA. Your IRA can purchase um, residential properties. It can be single family, multifamily. It doesn't matter. It can be apartments, condominiums. You can purchase commercial property, and you can also purchase undeveloped land within the IRA, and you can also invest into foreign properties. You just need to be aware of that localities, laws, and regulations when it comes to real estate. And that locality also needs to recognize the US LLC as an entity for this to work properly. Um, but yeah, in these scenarios, your IRA is the owner of that property, that piece of land, whatever it may be. And we'll go over the process of how the actual transaction works at a high level towards the end of the presentation or a little bit later. Not very, it's about in the middle of the presentation. But if you have any questions on any scenarios that you want to run through, you can always ask it in the chat. Or if you don't have time or you're watching this after the fact, just give us a call and we can walk through scenarios with you as well over the phone. Next asset class that's very popular, another passive, pretty passive asset class is private lending. You can turn your IRA into a mini bank. So you can do secured or unsecured notes. If you secure it, it can be in the form of a mortgage. You can do trust deeds. You can do leases. You can do convertible notes where that note turns into shares of or equity into a company at a certain trigger throughout the investment. You can also do discounted notes. The IRA doesn't have to originate the note. You can buy notes on the secondary market with your IRA as well. And these are some options that our clients invest into every day. Next up, probably the most common asset class we see at Camo Plan. But again, we have people investing into all of these options. But because of the passive nature of private placements, this is before companies go public. You can't purchase these shares on the stock market with your IRA, so people have to do it through a vehicle called a private placement. This is when you're purchasing shares of a privately traded company within your IRA, and then if it goes public, then you can, and it goes out with an IPO, you can have it converted and then transfer it out to your other custodian if you'd like. But this is before it goes public. This is when you're an angel investor and they're just getting investors. These are some of the options that you can go through. Again, probably the most common asset I see at Camo Plan. They'll most likely have a subscription agreement, a private placement memorandum, and on that subscription agreement, the subscriber on that is going to be the IRA, which is a separate entity from you, similar to a trust. And that works. It works the same for pretty much every asset class in that respect. And we'll go over that very shortly when we go over the process. Another asset class people use for diversification, are precious metals and commodities. So people can purchase gold, silver, palladium, platinum within their IRA. And then there's an option also called the precious metals composite. That's an option that's a combination of those previous four metals. That is patented by Neptune Global. That can be also purchased within your IRA. And then we have the option for certain coins and bullions at the end. The IRS does have guidelines based for the metals that you can purchase out of the IRA. They have to meet certain minting quality standards in order to be held within the IRA. And we'll go over the prohibited transactions following this because you can see the restrictions right there below. So we just talked about what you can invest in with your IRA. Now we're going to talk a little bit about what you can invest in too with your IRA. So these are mainly hard to value assets, mainly collectibles and life insurance. So any works of art, antiques, metals, Again, there's an exception for certain minting standards and quality standards below. Stamps, any collectibles that hard to value assets. The IRS wants to know what's the value of the IRA is at the end of every year. If you put a piece of art into an IRA, you can say somebody can throw paint on the canvas and say that's worth $1 million, where somebody else might look at it and say that's worth $5. So these are hard to value assets. The IRS doesn't want you putting these assets within your retirement accounts. There are also additional rules when investing out of your IRA, and I'll make a point. This isn't just self-directed IRAs. These are any IRAs. It just tends to come into the forefront a little bit more when you're doing these alternative assets. But when you're investing out of your IRA, it has to be strictly for investment purposes and arm's length transactions. So what's also prohibited within the IRA is self-dealing and personal use. So the IRS doesn't want you receiving direct benefit from the IRAs and investments, nor can it be providing a direct benefit to the IRA and its investments. Within the realm of real estate, if your IRA purchases a property, you can't work on that property at all, put any sweat equity in there, and you can't live in that property at all. And it's not just you. There's also some disqualified persons included in these prohibited transactions by the IRS that we're going to go over within the next slide. Excuse me. So here's a chart that we like to show people. This shows the disqualified persons, including the account holder or yourself. Anybody of lineal ascent or descent of you, parents, grandparents, children, grandchildren, their spouses, and any entity that these people own 50% or more of or have managing power are also prohibited from receiving a direct benefit from the IRA and its investments, or providing direct benefit to the IRA and any of its investments. Now, you can partner with these entities. Your IRA can partner with these entities. They just can't be receiving any direct benefits in addition to their percentage of ownership in that investment. The people in blue are disqualified and the people in green are okay. So where you may not be able to lend money out of your IRA to your children or grandchildren, you can to siblings, nieces, nephews, aunts, uncles, and cousins, and other individuals in green. So like I said earlier, we're going to go over the process and what that looks like. Again, this will vary from asset to asset. This is at a very high level, but it's pretty simple. It looks like a lot of steps, but a lot of these are behind the scenes. The way it works is first you'll open up an account at Camaplan. It takes about 15 minutes and can be done online. The account you open at Camaplan will need to be similar to the account that you plan on funding it from. So, for example, if you have a traditional IRA at Schwab and you want to use that to self-direct, then you would need a traditional IRA at Camaplan or another tax-deferred account that can accept those funds. Then the way you fund your account, there are three options. You can do it via contribution, transfer from an IRA, or rollover from an employer plan. So in that same scenario as before, if you had the traditional IRA at Schwab, you would want to, and you open up a traditional IRA Camaplan, you would want to do a transfer from that existing IRA. The way that works is you fill out our transfer form, and we actually go out and request those funds on your behalf from Schwab. The next step is to choose the investment. Once the account's been funded, next you'll identify the investment you want to make. So if you're interested in purchasing real estate, you'll identify a property. If you're interested in lending money, you'll identify the borrower. If you want to be an angel investor and invest into privately traded companies, you'll identify that company, and you'll do your due diligence for each one of these investments, depending on obviously the investment you want to make. And then the next step is to submit the purchase paperwork for that investment. Obviously, supporting paperwork for different assets are different. So, but the one common denominator is that we need an asset purchase directive. That's a Camaplan form. It's just a direction of investment form. Tells us what you're investing in, how much you're investing, where you want the money sent, and how you'd like the money sent. Excuse me. Along with that asset purchase directive, it will be the supporting paperwork. So if it's real estate, you'll have something along the lines of an agreement of sale. If it's private lending, you'll have a promissory note and security paperwork. If it's a secured note, for privately traded companies, you'll most likely have a subscription agreement, a PPM, and other documents we can go over. And then if you're purchasing precious metals, there'll be an invoice and so on. Once they've been submitted to Camaplan and are in good order, we'll process that within 2 business days of receiving the paperwork in good order, and then we'll release the funds based off the instructions on that asset purchase directive. You'll be able to log into your online account at Camaplan and see that asset within the IRA on your statements and in that online portal I mentioned. Then any returns will go back to the IRA, and then you can choose to reinvest them, transfer them back out to another custodian when you're in between deals, or take them personally, depending on your your wishes and your current tax strategy. Timeline for this process: to open an account, again, it's about 15 minutes. To fund the account, it tends to be a little bit of a longer process. We'll help you throughout that, but we're not the one who dictates that timeline. It's the other custodian who are releasing the funds. Again, we process everything within Camaplan within 2 business days of receiving paperwork in good order, from funding paperwork to investment paperwork, application paperwork, will be done within 2 business days. With funding the account, we tell people to expect on average about 2 weeks for that to take place. Again, we're not the one that decides that timeline. It depends on the other custodian. I've seen people get funded as quickly as the following day from when they submitted the funding paperwork, and I've also seen people wait 2 weeks or over 2 weeks, depending on the other custodian. Then, like I said, 2 business days to process the purchase paperwork. So from the date you open the account to the date you make your first investment, I tell people to expect on average about 3 weeks. Again, there are variables involved, so it could be quicker, it could take a little bit longer, but 3 weeks tends to be pretty accurate. So all of that was good information, I'm sure, or at least I hope. Why do you need Camaplan? Why can't you do it yourself? The IRS requires that you have a third party to keep record of the transactions and report to them at the end of every year, for your IRA, and that's what we do. We're a neutral third party. We don't give you advice. We don't sell any products. We don't endorse any products. We keep record of the transactions, report to the IRS at the end of every year, where we consider ourselves a part of your core team of professionals. So if you have attorneys, CPAs, or financial advisors that you want involved in the process, we are very happy to have them included, and we would recommend you bring them in, whether it be a conference call or an email thread, to make sure that everybody you trust is involved in this process, with your investment from your retirement account. Some frequently asked questions. A lot of these were covered in the presentation, but to kind of speed through these: what is the timeline to open and fund a self-directed IRA? To open the account, about 2 business days from receiving the paperwork in good order, but it takes about 15 minutes to open it online. We just need to review it on our end. Fund the account is on average about 2 weeks, depending on the other custodian. And we process all investments within 2 business days of receiving paperwork in good order. How do you fund an account? And how long does that take? Again, about 2 weeks on average, about 2 weeks. And how do you do it? The options are either contribution from your personal funds, transfer from another existing IRA, or rollover from an employer plan. All those processes are slightly different, but on average, about 2 weeks. Obviously, contributions will be much quicker. You can do that immediately through your online portal. But when you're working with another custodian of an IRA or an employer plan, then that 2-week timeline comes back into play. Walk me through how I invest in an asset through a self-directed account. You open the account, fund that account, which we just went over. Then you submit the purchase paperwork. So we have that asset purchase directive, which tells us what you're investing in, how much you're sending, where you'd like it sent, and how you'd like it sent. And then depending on the asset class, you'll send in the supporting paperwork too, where the subscriber, lender, purchaser on that paperwork is the IRA, which is a separate entity from yourself, similar to a trust. So when you're working with Camaplan, the way it would look is Camaplan FBO, which stands for benefit of, your name, IRA or Roth IRA, SEP IRA, simple IRA, whatever type of account you have with us. Then that brings into who signs the paperwork when I invest. You'll submit that paperwork to us. You'll initial next to the signature line for the IRA. That lets us know that you've read and approved of the agreement. And once everything is in good order and we've processed the paperwork, we'll sign on behalf of the IRA as third-party administrator and send the funds to the investment provider. Next question: can I use my IRA for the down payment of a property I want to own personally? The answer to that is no. So whatever percentage the IRA owns of an investment or an asset is the percentage of all expenses it has to pay and the percentage of all return it's entitled to. So when it comes to real estate, the expenses that are included in that are down payment, purchase price, utility bills, renovations, Any expense for that property has to be paid based off the percentage of ownership of the IRA. So if the IRA owns 100% of that property, the IRA has to pay 100% of the down payment, 100% of the purchase price, 100% of all expenses, any utility bills, renovations, anything like that has to be paid out of the IRA. And then any return from that property, whether it be rental income or the eventual sale of the property, has to be returned 100% to the IRA. Now, you can partner with different entities, and the IRA can own different percentages based off what works best for that specific deal. In the event the IRA owns only 50%, then you have to break up expenses and return based off that 50% ownership as well. And it doesn't have to be 50-50. It could be 60-40, 70-30, whatever works best for you. You just need to make sure to break up that those expenses and income based off that specific percentage. Next question, can my IRA receive a loan to purchase a property? You can actually, your IRA, can actually receive financing for investment you want to make out of the IRA. However, it can't be through your traditional financing sources. It has to be through what's called a non-recourse loan. For those who are unfamiliar with non-recourse loans, it's basically the IRA is a separate entity from yourself, so you can't personally guarantee it. And then when you make these non-recourse loans, the only recourse lender has is usually to go after that property that the loan is secured to. They can't go into your other IRAs that Cayman Plan. They can't go into your IRAs or retirement accounts outside of Cayman Plan, and they can't go after your personal belongings. So because of these restrictions on the borrower, or the lender, the requirements tend to be a little bit higher, and the terms tend to be a little bit higher as well. I'm not a non-recourse lender. Talk that over with your non-recourse lender to get more specific information about their requirements. But yes, your IRA can receive a loan to purchase a property. In addition to that information, usually IRAs don't pay taxes, but in some instances they do. And this is where that UDFI we talked about at the very beginning of the presentation comes into play. So that unrelated debt financed income would be triggered if you were to receive financing for an investment out of your IRA. And we'll talk about that in, I believe, the next slide, if not the slide after. A little bit more information about taxes within an IRA, those rare events. Can I manage the property my IRA owns? So it really depends on your definition of manage. You can pick the tenants. You can screen the tenants. You can submit payment requests for the asset owned by the IRA. Now, you just can't go in there and work on the property yourself. Like, you can't pick up a paintbrush and paint the walls. You can pick the color of the paint, but you have to pay somebody else to paint the property. Your IRA has to pay somebody else to paint the property. But some people will also choose to have a property manager manage the property within their IRA. That means that property manager has to be paid by the IRA. But some people also just do it themselves by submitting payment requests directly through Cayman Plan and picking their tenants and managing it from afar, from an arm's length. Last question we have of the frequently asked questions: what do I do if or when there's a capital call or an investment needs additional funding? So for existing assets within your account at Cayman Plan, what you can do is log into your online portal and submit a payment request. So if you're invested in a fund and they're called capital and they need an additional payment from you, you'll submit that capital call through your online portal, tell us instructions on how you'd like that paid, and then we would pay that with the cash available within your IRA. Usually those are processed within 1 business day if it's done through the online portal. And this also applies to if you have an installment payments for a loan or something along the lines of that. It's pretty simple, quick and easy. You can do it from your online portal. And those are the frequently asked questions. If you have any other questions, just type them in the chat. Now we're going to talk about those rare tax considerations and some additional resources for you to bring to your tax professional. So the 2 types of taxes that an IRA has potential to pay, usually they're tax sheltered accounts and don't have to pay taxes when the funds are within them. There are these 2 instances that will trigger a tax within the IRA. Bring this information to your tax professional if what you're looking to do you think may fall into one of these taxes. So the 2 taxes that can be paid are UBTI. Some people refer to it as UBIT or UBIT. That stands for unrelated business income tax. And then UDFI, which we just talked a little bit about, unrelated debt financed income. So for unrelated business income tax, this is when the IRS deems that you're doing transactions not within the realm of the original um, intent for the IRA, mainly if the IRS thinks you're running a business within your IRA. So the two main things I see trigger the UBIT tax are flipping properties. So if your IRA purchases a property and then renovates it and sells it, that potentially could trigger a tax. What the IRS defines as a flip, they'll never say, and they haven't said, excuse me. Some people say you, if you do one a year, you're okay. Some people, if you say if you hold it for this long, you're okay. But those people are not the IRS. The IRS will look at it as inventory in and inventory out when you're flipping properties, the properties to say, and that could trigger the UBIT tax. And then another way that I've seen trigger the UBIT tax, or I've heard trigger the UBIT tax, excuse me, is developing on undeveloped land. So your IRA purchases a plot of land, and then your IRA hires a development company to build on that plot of land. That could trigger the UBIT tax within the IRA. Then right below it, we just talked about unrelated debt financed income. So if your IRA receives financing to purchase a property or for an investment within the account, then that would trigger unrelated debt financed income. If either of these events occur within the IRA, or you think they may have occurred, you talk it over with your tax professional. They'll identify if it is something that your IRA needs to pay, how much your IRA has to pay, what percentage, and the amount. They would file a Form 990T and then send that into Camaplan. And we would sign it and send those funds to the IRS based off the instructions on that 990T. People that do end up paying these taxes are usually okay with it because the amount they're making offsets the taxes, and they're able to earn more than they would be outside of the self-directed investment or within their traditional assets. So they're okay with it, but it really depends on the income and that investor in specific. So here we have a bunch of publications, court rulings, forums, publications from the IRS that we pulled all of this information from for this presentation to prove to you that we didn't just make it up out of thin air. Please feel free to read these at any time. If you have trouble sleeping, keep it by your bedside. I hope that may help you. But this again is where we pulled all of that information. If you're questioning anything within this presentation, please do your due diligence. Read these rulings, publications, forums. Look up the court cases on our website. But again, this is where all the information was pulled from, and that is the presentation. If you have any questions at any point, please feel free to reach out to Camaplan, give us a call, shoot us an email. I love to talk people through their, specific scenarios, what they want to do, what they're looking to do. And I also help people open their account and fund their account. And I'm always happy to do that. So please do not hesitate to contact me or one of my teammates at Camaplan. And I hope you pulled a lot from this presentation. And I want to thank anybody who's attended live or is watching this after the fact. And I hope you all have a great rest of your day.